Federal Reserve prints money means the inflation goes up because they are printing money and bringing in money into the market means the inflation goes up. The buying power of the people increases. So the asset prices goes up because there is more demand. So this will lead to higher yields. Higher yields means higher borrowing cost. So this is again a vicious cycle wherein higher borrowing cost means the government has been trying to reduce the debt burden, but then this will finally lead to increased debt burden. This is how worse the US is in a situation wherein how to get out of this. To reduce the debt burden of US government, what they have to do? They have to cut the interest rate. So if they cut the interest rate, what happens? As there is high inflation in US, and if the inflation is high and if the interest rate is cut, means their borrowing cost reduces. So your FD returns reduces and also your home loans and other borrowing costs reduces. So they buy more homes. The buying power increases more. You have more money because you are getting money at cheaper borrowing rates, cheaper interest rates. Means your inflation further increases. So inflation increases as the inflation is already high, and if you cut the interest rate, the inflation further increases. In this case, the US Fed and the US government will send out a big message to the worldwide bond investors who are holding US debt that we are more concerned about the US economy and we are not concerned about protecting your money, because as inflation goes high, then the return from bonds has to be increased, right? But if the inflation goes high, then the small returns which they are getting from the bonds become insufficient. So they give a message that they are not concerned about the money or the value of the bond which the bond investors are holding worldwide, and they are concentrating on saving the US economy. So in that case, what happens? As the inflation is so high and the bond yields with respect to inflation is very less, they are unable to have a delta or higher percentage of bond yield compared to the inflation rate. They sell the bond because the investors understand that if the Fed keeps cutting the interest rate, going forward the inflation is going to be so high and the bond yields, the returns from the bonds is not sufficient enough to beat that inflation. They no more value the bond and they sell the bond. So if they sell the bond value reduces. The demand for that bond reduces means the bond value reduces, but the coupon rates are fixed. So if the coupon rate is fixed, the bond yield increases. So the bond yield increases means if the US has to issue more bonds for more money printing, so they will have to issue higher interest rate for the bonds because the bond yields of previous bonds has increased. So say 5% was the coupon rate and they have sold that bond and the value of the bond reduces. So the yield of that previous bond becomes 6%. So the new bonds which the US is releasing at least has to be same as that of that or higher than the 6%, so that the new investors will invest in the new bonds. Otherwise, they will stick to the old bonds only. The interest rate of new bonds has to be increased by the US government, means the borrowing cost of the debt of the government further increases, which further adds to the 40 trillion debt burden of the US.